As of right now, the stock market is closed for the weekend on Saturday, August 8, 2026. The trade desk closed its most recent official trading session on Friday, August 7, 2026 at 4 p.m. Eastern Time at a price of $13.80 per share. That final closing figure represents a sharp intraday drop of $3.87 or a 21.90% decline on extraordinarily heavy volume exceeding 133 million shares. When a dominant technology company suffers a single-day drop of over 20%, the immediate market assumption is that a temporary glitch or short-term panic is driving the selling. The consensus belief among retail investors and casual observers is that demand-side ad platforms remain invincible juggernauts as traditional television ad spending migrates toward connected television and digital channels. The reality behind this massive sell-off is far more structural and challenging than a simple headline miss. What the market is reacting to is a fundamental recalibration of growth expectations, driven by tightening corporate marketing budgets, pricing pressures across programmatic inventory, and a sharp reduction in forward revenue guidance. While Wall Street expected steady double-digit expansion based on long-term secular trends, the immediate reality shows that ad buyers are trimming experimental spending and demanding higher efficiency, leaving pure-play demand-side platforms exposed to near-term margin contraction. To understand why this gap between expectation and reality created such a violent reaction, you have to look closely at the trading mechanics from Friday's session. The stock opened the day at $12.87, immediately dipping to a low of $12.83 before mounting a minor midday recovery to a high of $14.57, only to settle near the bottom of its intraday range at $13.80. A trading volume of 133.34 million shares compared to a normal daily average of under 40 million indicates that institutional funds were actively rebalancing and shedding risk. This was not small-scale retail selling. It was massive institutional distribution triggered by downgraded price targets and reduced revenue projections. Analysts across major research firms quickly cut their targets, pointing out that macro headwinds in consumer retail and automotive advertising are directly impacting bidder liquidity across the open web. When investors track major market indices, their attention often centers on mega-cap tech titles like Tesla stock, Apple stock, or Nvidia stock. Yet software enablers like the trade desk often act as early economic indicators for wider corporate sentiment. When companies begin scaling back their overall budget commitments, digital ad platforms feel the friction long before consumer spending metrics officially reflect a slowdown. Investors who utilize individual brokerage accounts through online investment sites regularly look at these pullbacks as potential buying opportunities. Whether someone manages their portfolio using Schwab Intelligent Portfolios, sets up an automated intelligent portfolio, or uses self-directed tools for self-investing and invest online strategies, distinguishing between temporary market noise and genuine fundamental impairment is essential for long-term capital preservation. The surface narrative surrounding digital advertising usually assumes that as long as consumer attention moves to streaming services, ad tech platforms will naturally capture higher revenue. The deeper truth is that media buying platforms do not operate in a vacuum. Demand-side technology platforms rely on volume and take rates. When large brand advertisers shift toward direct deals with walled gardens or cut back on spot market programmatic buys, the aggregate spend moving through self-service platforms experiences immediate friction. While retail traders on platforms like Robinhood use the Robinhood app for Robinhood stock trading, buy Robinhood fractional shares, or allocate capital across Robinhood Crypto and Robinhood Cash Management, institutional trading desks evaluate raw metrics such as platform take rate, customer acquisition costs, and operating margins. If you look across modern retail brokerage environments, the contrast in investor sentiment becomes clear. On platforms like SoFi, where users engage with SoFi Invest, SoFi Active Investing, SoFi Stocks, SoFi ETFs, SoFi Trading Platform, and the SoFi Robo-Advisor, retail interest often spikes during major pullbacks as dip buyers attempt to time a bottom. Similarly, sophisticated global investors using Interactive Brokers leverage Interactive Brokers Trading, the Interactive Brokers platform, and Interactive Brokers account features to analyze order flow, short interest, and Interactive Brokers fees before placing trades. At the same time, long-term investors managing assets through Fidelity, utilizing Fidelity Investments, Fidelity Mutual Funds, Fidelity ETFs, Fidelity IRAs, Fidelity Wealth Management, the Fidelity mobile app, or the Fidelity trading platform via a Fidelity brokerage account, are evaluating whether this severe valuation reset brings the stock's price-to-earnings ratio into a realistic range. To properly evaluate where the company stands today, we have to examine its core business model and historical performance. The trade desk operates as an independent demand-side platform that enables ad buyers to purchase and manage digital advertising campaigns across multiple channels, including connected TV, display, video, audio, and mobile. Unlike walled gardens that own both the media content and the advertising sales mechanism, the company positions itself as an objective buy-side partner. Its proprietary software allows agencies and brands to target specific audiences, manage frequency, and optimize performance in real time using data-driven algorithms. Over the past several years, the company established a strong track record of double-digit revenue growth, expanding its footprint through strategic industry initiatives like Unified ID 2.0, an open-source identity framework designed to replace third-party cookies. However, past financial success can create an expectation anchor that blinds market participants to shifting realities. In previous quarters, revenue expanded rapidly as connected TV adoption accelerated, causing investors to price the stock at a high price-to-earnings multiple. When a business carries a premium valuation, any deceleration in growth rate or slight reduction in margin expectations leads to a disproportionately large share price correction. That is precisely what unfolded during Friday's trading session. The market realized that operating cost increases combined with a temporary softening in ad spend from major brand advertisers meant that top-line revenue growth could no longer support its previous valuation multiple. Comment below how many shares of the trade desk you currently hold in your portfolio, or let me know if you are planning to wait for further price stability before making any new moves. Looking ahead, the future outlook for the company rests on a clear set of catalysts, potential risks, and strategic opportunities that tie directly back to the expectation versus reality dynamic. The optimistic scenario relies on the continued expansion of connected TV advertising and the widespread industry adoption of Unified ID 2.0. As traditional linear television continues to lose subscribers, brand advertisers must redirect billions of dollars into ad-supported streaming platforms. Because media inventory across streaming networks remains fragmented across dozens of providers, buyers desperately need an independent demand-side platform to aggregate inventory and manage ad frequency across different apps. If connected TV ad spending rebounds strongly in upcoming quarters and retail media networks continue integrating with open web programmatic platforms, revenue growth could re-accelerate and restore investor confidence. On the other hand, the key risks facing the stock cannot be ignored. The most immediate threat is ongoing macroeconomic uncertainty that leads advertisers to reduce variable marketing expenditures. Furthermore, competition across the ad tech supply chain continues to intensify. Supply-side platforms are developing direct-to-publisher buying options, while major walled gardens continue building proprietary tools that bypass third-party platforms altogether. If taking fees become squeezed, or if major streaming publishers decide to build in-house ad sales platforms rather than relying on external demand-side technology, long-term margin targets will come under pressure. Investors seeking solid investment help must carefully weigh these operational risks against current market pricing. When analyzing any growth technology stock after a severe drop, the fundamental question is whether the decline represents a permanent structural shift or a temporary valuation reset. The expectation among bullish investors was that the company's competitive